Welcome back to the afternoon session of the June 5, 2025 Investor Advisory Committee meeting. Adam, do we need to note if any IEC members have joined or departed as we're returning to the public session?
This is Andrew.
Looks
like we are missing Gina Gale. And Christina, are you online? Christina, are you on? I see. You're muted. Okay. I don't know if she's online now, but Gina Gale is here. Okay. Then everyone else is here.
Okay, thank you, Andrew. Our afternoon session begins with our panel, Beyond the Gap, Market Perspectives on Non-GAAP Financial Disclosures. It'll be moderated by James Andrews, who's chair of our Investors Purchases Subcommittee, and it'll be followed by a discussion of a potential committee recommendation. James?
Thank you very much, Brian. Beyond the Gap, Market Perspectives on Non-GAAP Financial Disclosures. Welcome, everyone. Today we gather to examine a critical issue in financial reporting, the growing use of non-GAAP financial measures and whether enhancements to regulation or guidance are necessary to ensure transparency and enhance investor confidence. In the United States, financial accounting standards are developed by the Financial Accounting Standards Board, FASB, an independent body that ensures consistency and comparability in financial reporting. The SEC requires companies to submit financial statements in accordance with U.S. Generally Accepted Accounting Principles, GAAP, as established by FASB. Non-GAAP financial disclosures supplement traditional GAAP measures and have evolved from a specialized practice once prevalent in select industries like dot-com companies to a widespread phenomenon scrutinized by investors, regulators, and academics alike. Their appeal lies in offering alternative perspectives of profitability, liquidity, and solvency, sometimes presenting a contrasting narrative to official accounting results. This shift has led to increased interest in their implications for financial communications and investor decision-making. The SEC has led robust discussions on non-GAAP over the past 25 years, leading to enhancements in regulations and guidance. However, non-GAAP remains one of the most heavily commented areas by SEC staff when reviewing disclosures. Non-GAAP disclosures are also a source of frequent litigation. It is clear that non-GAAP measures provide valuable insights beyond traditional financial statements, helping investors better understand underlying performance. However, because they fall outside standard financial auditing and regulatory frameworks, they also carry risks, potentially serving as tools for opportunistic financial reporting, where companies selectively highlight favorable metrics while downplaying less attractive results. This raises concerns about comparability, reliability, and investor protection. As non-GAAP measures gain prominence, regulators have sought to strike a balance, preserving the usefulness of these disclosures while mitigating manipulation. The debate remains lively. Some researchers argue that non-GAAP measures enhance financial communication, while others emphasize their potential for misleading investors. Existing oversight mechanisms, such as SEC staff reviews and non-GAAP related litigation, highlight the limitations of current processes, leaving open the question: should we strengthen regulatory control, and if so, how? Traditional GAAP metrics provide a necessary baseline for financial reporting. But as business models shift, especially in technology-driven industries, there is a need for different information, and the question arises whether the SEC should beef up non-GAAP financial reporting guardrails, or if FASB should enhance the traditional GAAP metrics. It is the case that misalignment between revenue recognition, expense matching, and intangible asset valuation has created an environment where non-GAAP voluntary reporting may thrive. This sparks a broader conversation about whether financial reporting standards need to evolve alongside modern economic realities. Today's discussion will explore overall effectiveness of non-GAAP reporting, the current state of regulatory oversight and enforcement, the prominence of non-GAAP reporting, effectiveness of management and audit committees, investor perspectives, and potential improvements. Ultimately, as the use of non-GAAP measures continues to grow, it is imperative that we assess whether existing frameworks effectively safeguard investors while supporting meaningful financial communication. With these considerations in mind, let's begin our discussion. I'm proud to have 5 phenomenal practitioners in Timothy Brown, Stephen Gray, Vanessa Teitelbaum, Jeff Mahoney, and Jose Rodriguez. Timothy is an audit partner in KPMG's Department of Professional Practice, where he serves as the topic team leader of the SEC Regulatory Matters team. He advises companies and engagement teams on various aspects of SEC regulations and reporting matters. He has authored numerous publications, including some non-GAAP metrics. Timothy will get us started by providing us a baseline in terms of what we are talking about. Even when talking to investors, non-GAAP may be something rather fuzzy, but it's important that we start with Timothy in order to establish that baseline in what we will be talking about.
Thank you very much, James, and wanted to say thank you for inviting me to the panel today. I'm really pleased to be here, and thank you to the Investor Advisory Committee and the SEC more broadly for putting this on as well. I think it's an important session. So this past weekend, I was at Six Flags Great Adventure with one of my 3 sons. He had a competition with his middle school jazz band, and after they competed, they had the opportunity to explore the park and ride all the rides. I'm sure most of us have been to amusement parks before, and you might be familiar with a ride called a tilt-a-whirl ride. Well, just in case you're not, it's a flat ride. It has a circular rotating platform, and on the circular rotating platform are cars that independently spin on their own. And as I was looking at this weekend, I had a thought that in many ways, non-GAAP measures and the disclosures of such sometimes feel like that tilt-a-whirl ride. Constituents on all sides of our proverbial financial reporting table feel as though they're going in circles at times when trying to land in the right spot with respect to disclosures of non-GAAP measures. Some constituents may feel as though they're trying not to be thrown off the ride altogether every once in a while. So as James said, I'm going to start off with some basics and try to level set with everybody here in the room and everyone joining us online today. So let's begin on the next slide with what non-GAAP financial measures are. Non-GAAP financial measures are financial metrics that companies use to provide additional insights into their financial performance, condition, or cash flows, which they believe are not fully captured by GAAP metrics. More simply put, they are financial metrics that are not defined by generally accepted accounting principles, or GAAP. And as a reminder, we have both US GAAP and IFRS IASB as acceptable GAAPs in the US market, not to mention the home country GAAPs with reconciliation. Companies use these measures to give investors and analysts a more robust picture of their operational performance or financial health. These measures can be particularly useful to investors when comparing a company to its peers or assessing trends over time for that company. For example, they might highlight aspects of a business that GAAP metrics do not fully capture, such as adjusted earnings or free cash flow. Defined specifically, a non-GAAP financial measure either excludes amounts that are included in the most directly comparable measure, calculated and presented in accordance with GAAP, or includes amounts that are excluded from the most directly comparable measure, calculated and presented in accordance with GAAP. Certainly, some non-GAAP measures do both of these things. To ensure transparency, companies are typically required to reconcile non-GAAP measures to the most directly comparable GAAP measure. This reconciliation provides those exclusions or inclusions that I just mentioned and helps investors and analysts see how the non-GAAP figures relate to the standard GAAP metrics, providing a deeper understanding of a company's financial performance. However, it's important to state that non-GAAP measures are not standardized. This means they can, and they do, vary significantly between companies and even direct competitors. As a result, users of financial statements need to understand the specific adjustments that are made, the rationale behind those adjustments, and the context in which those adjustments are presented. This variability can sometimes make it challenging to compare non-GAAP measures across different companies. Through careful analysis, however, investors and analysts can use these measures to make more informed decisions based on a comprehensive view of a company's financial performance and health. On the next slide, I wanted to take us through the regulations that sit today. The SEC has a couple of regulations that govern disclosure of non-GAAP. The importance of these regulations is underscored by their role in investor protection, market integrity, and compliance enforcement. They are designed to protect investors by ensuring access to accurate and comparable financial information. The regulations enable investors to make informed financial decisions by promoting transparency and consistency. Regulation G, or Reg G as it's affectionately called, applies whenever a company publicly discloses or releases material information that includes a non-GAAP financial measure with limited exceptions. So Reg G is broad in application and applies to non-GAAP measures whether or not they are filed to the SEC. Indulge me for just a moment here while I read a general disclosure rule from Reg G. A registrant or a person acting on its behalf shall not make public a non-GAAP financial measure that, taken together with the information accompanying that measure, contains an untrue statement of a material fact or omits to state a material fact necessary in order to make the presentation of the non-GAAP financial measure, in light of the circumstances under which it's presented, not misleading. That is a mouthful. And it contains a number of commas and vested negatives. If we think back to the tilt-a-whirl I mentioned earlier, this basic premise is the cause of great consternation. Reg G also contains a reconciliation requirement, which mandates that companies provide a clear and quantitative reconciliation of non-GAAP measures to the most directly comparable GAAP measure. Additionally, Reg G requires that these measures do not receive undue prominence compared to GAAP measures, and any adjustments should be justifiable and clearly explained. In comparison, Reg SK requirements are narrower than Reg G and only apply when GAAP measures are filed with the SEC. Item 10E is also narrower in that it takes the broad premises of Reg G and sets clear markers for a preparer to follow. As an example, Reg SK requires reconciliation to GAAP, but provides more context as to what may be adjusted. One instance is that the regulation states that the registrants may not adjust a measure to eliminate or smooth items identified as non-recurring, infrequent, or unusual. That specific prohibition does not appear in Regulation G. Other requirements in SK include mandating that non-GAAP measures be presented consistently across reporting periods, clear definitions of each non-GAAP measure, and disclosing why management believes these measures offer useful insights to investors. Besides the regulations themselves, the SEC staff has provided a great deal of interpretive guidance over many years. This guidance provides even more detailed instructions to enable transparent and consistent presentation, and to safeguard against misleading financial disclosures. This guidance is important, as it provides a window into the expectations of the SEC staff that registrants can reference when preparing measures and that investors can look to when trying to understand these measures. Compliance and disclosure interpretations, or C&DIs, are one form of interpretive guidance, and they are used extensively for non-GAAP reporting. C&DIs offer clarification and detailed advice on how companies should adhere to the SEC's disclosure requirements. Ultimately, compliance with these regulations and the staff's guidance is crucial for registrants to communicate effectively with investors. Disclosing measures that do not comply with the regulations may result in comments from the SEC staff and the need to revise filings. Non-compliance with these regulations can potentially also lead to enforcement action by the SEC in extreme circumstances, resulting in penalties, reputational damage, and a loss of investor confidence. So on the next slide, we have a few examples of where the regs apply specifically. And this is really just meant to provide those examples for everybody. As I mentioned on the previous slide, Reg G has broad application. It applies to registrants' use of non-GAAP measures in most circumstances. So press releases, earnings calls, investors' presentations, and other public communications. But it also does apply when non-GAAP measures are used in SEC filings. 10E, as I said, is applicable when there is a filing with the SEC that includes a non-GAAP measure. So your registration statements, your periodic reports. It also applies to documents that are filed on Form 8K, such as an earnings release with the SEC. And it applies in part, actually, to earnings release that are furnished under Item 202 of Form 8K as well. On the next slide, we have some common non-GAAP metrics. So what are these common non-GAAP measures that are generally accepted by the staff? Well, EBITDA, adjusted earnings, free cash flow are all good examples of measures that are provided on a regular basis. To the extent that these measures are not quote unquote adjusted from standard definitions, and they're explained adequately in disclosures that discuss the non-GAAP measures being used, we frequently see these as acceptable to the SEC staff. It is important to note here, however, that while standard measures are used frequently, everyone has heard of EBITDA, obviously. Many measures that are used by companies are in fact quote unquote adjusted. The SEC staff will comment on adjusted measures that are not labeled as such. They will request that registrants clearly label adjustments and point out improperly named non-GAAP measures when they believe a user may not understand what that measure is. The adjustments to basic measures are where many of the disparate measures are created, and it's a place where, in this paradigm, the inconsistency exists. And that leads us into our next slide, which is on the SEC's areas of comment. And as James articulated, this is oftentimes the most commented on area of the SEC every single year. Recent SEC comment letter trends highlight the central issues of noncompliance with the regulations. The topics shown in the slide are the top areas of comment within non-GAAP measures by the staff. Many non-GAAP related comments are basic blocking and tackling. Prominence of GAAP measures tends to be the top of the list year over year and can be the easiest to solve. The next top area is appropriate labeling and disclosure. Non-GAAP measures and adjustments must be clearly labeled, and the measures must not use names that are similar to GAAP measures. Many comments result in simple fixes, and the comments are quickly resolved. A few examples of corrections that companies will make to resolve those comments include changing the ordering of the GAAP and the non-GAAP reconciliation, reconciling to a more closely related GAAP measure, altering the name of the non-GAAP measure, being more descriptive with names of the adjustments going into the non-GAAP measure, and not using other as a catch-all for what would otherwise be material items. The SEC staff roots out bad practices through their comments, and their good work helps investors and protects the capital markets. A great example of this is staff comments where a registrant uses a non-GAAP measure to present their results in a different way. If we step back and think about a situation where a registrant has recurring losses from operations, however, through non-GAAP measures and adjustments, they present an adjusted performance measure that highlights annual profits. On top of that, this registrant may actually highlight those recurring profits right at the start of its press release and its earnings release. The staff's guidance says that these practices are not permitted, and the staff, through comments, in extreme cases through enforcement, will require the registrant to remove those measures from and make changes to its disclosures. Where things become more complicated is when comments ask about other adjustments. Take normal recurring cash operating expenses as an example. Any expenses that are normal to the business, recurring in nature, and anything that's settled in cash are typically prohibited adjustments. You might think that what's normal, recurring, and cash settled would be easy to define. However, the devil is really in the details. Differences of opinion between members of the staff and management on these definitions can lead to multiple discussions and rounds of comments. Perceptions of what would be normal, recurring, or cash settled for one registrant versus a second registrant may result in differences of presentation between competitors. This can lead to a lack of comparability for investors, or worse, confusion amongst the investor community. The last category I'll speak to is where the tilt-a-whirl of the non-GAAP world resides: individually tailored accounting measures. The C&DI that was expanded in 2022 provided additional clarity that wasn't previously documented. That was helpful, and I really commend the SEC staff for making those adjustments. Prior to adjustment, the C&DI gave only one example, and that related to revenue. This seemed to be reinforced. Some registrants read that to mean that the guidance only applied to revenue. And that seemed to be reinforced through frequent staff remarks that revenue is quote unquote special. To be fair, all remarks that the staff made were consistent with their guidance. However, confusion existed in other areas where remarks were made, but none of them were documented for the preparer community to really dig in. The revisions to the C&DIs attempted to bridge this gap. No pun intended. Things that fall into the individually tailored accounting measure category include revisions that change GAAP outcomes. So think changing net revenue presentation to gross revenue presentation, or vice versa. What we refer to as cherry picking, or adjusting for only a portion of a GAAP metric and not the entire metric. So an example here is adjusting for a one-time executive incentive-based compensation expense, but not all incentive-based compensation expense incurred by the company. And then the last one, which is really where the rubber meets the road, which is measures that are considered broadly to be quote-unquote misleading. At times, it's difficult for registrants to understand what might be considered misleading, since what is misleading is also in the eye of the beholder. Also, what is misleading can shift over time and depends on the environment, policies, business practices, etc. Sometimes what is considered misleading by the staff is also information that has been requested by investors or analysts. One last point of frustration is when management perceives that the registrant is not being considered on a level playing field. That is, a registrant receives an objection to its use of a non-GAAP measure, while its competitor, or the entire industry, continues to present that same measure. Now, reasons for this can vary, and they can include differences in the business. They can include materiality of the adjustments that are being made at a particular business, and they go on. However, and at times, it's difficult to understand whether differences of opinion also play a role in these decisions. On the other side, the SEC staff in certain cases has come out with industry-wide guidance on certain measures as to whether they are permitted or when particular adjustments are not permissible. So as to not go on even further here, I'm going to wrap up my remarks to say that there are clear regulations that relate to non-GAAP measures, and there is quite a lot of staff guidance, both documented and made through remarks of the staff over time. Investors and registrants are well served to understand those rules, understand the guidance, including the staff positions that are taken, and how they evolve over time. Communications between constituencies will help to bridge the disconnects on what does or does not apply with regulations. Together, I think we can all work to make sure that our day at the amusement park and our ride on the Tilt-A-Whirl keeps everyone happy and on board. Thank you.
Thank you very much, Timothy, for getting us started and getting us grounded in this thing called non-GAAP. I think what I heard is that it is incredibly important. However, we do not have a regulator that formalizes all of non-GAAP, and significantly, it's not audited as well. So we will move on to get an investor perspective on this complex topic, and to do that, we have Stephen Gray, Managing Principal, Gray Value Management. Stephen is the founder and managing principal of Gray Value Management, LLC, a privately held investment entity that oversees the Gray Value Opportunity Fund, an investment partnership dedicated to generating absolute returns through a focused portfolio employing long and short strategies across all industries and markets globally, including equity, debt, commodities, and derivatives. Let's go, Stephen.
Thank you. I'm very happy to be here today. Thank you for inviting me. It is a privilege to participate. Slide, please. Because I invest for a living, my views on financial reporting are heavily influenced by those responsibilities. I operate where policy and enforcement meet practice. I put it that way because I absolutely cannot do my job unless the SEC, FASB, the PCAOB are able to do theirs. To put a finer point on that, I cannot possibly fulfill my responsibilities as a fiduciary if those entities are not able to pursue their mandates. More broadly, I think that we all grasp that the less investors trust the reported financials, the less they will trust the market overall. We all also know that the more suspect the accounting is, the higher the cost of capital. That's the high altitude take. What's the view at ground level? All accounting conventions, GAAP, non-GAAP, IFRS, are an interpretation, an expression of an underlying economic reality, which means that any analysis of a financial statement is ultimately an interpretation of an interpretation. Whether it's GAAP or non-GAAP, I know it's all at least once removed from the financial reality I'm trying to understand. If there's nothing I can do to diminish that distance, if it's a feature of the system, not a bug, then as an investor, I welcome any additional information that might help me come to a more comprehensive financial understanding of what I'm looking at. That includes any non-GAAP numbers management might want to offer. Now, let's be honest here. It's not as if any of us are mistaking their intent. Corporate management isn't offering non-GAAP numbers because they make their performance look worse. Non-GAAP measures are essentially a form of financial spin. So when we talk about, to quote the program, the risk that non-GAAP metrics may be presented in a way that emphasizes a more favorable outlook than GAAP reporting alone might suggest, my response is, of course. That's why they're doing it. But I don't say that as an indictment, because as long as it is consistent and not fabricated or technically inaccurate, more information is always better. In my experience, simply contrasting the GAAP financials with the non-GAAP figures can yield important insights. By way of concrete example, next slide, please. Avaya is a company I invested in and later wrote about in the Financial Times. What you're looking at is a snapshot of the article I wrote back in August of 2022. Avaya got my attention because it had just been through bankruptcy and it was a global leader in the contact center market and UC, Unified Communications, helping businesses integrate all of their communication capabilities. With a much cleaner balance sheet, an already attractive investment opportunity became only more so when demand for UC skyrocketed as a result of the pandemic. So Avaya became a big position for our fund, which for us is about 10% of our capital before taking into account any appreciation. And the stock did appreciate significantly. But as we followed the company's performance, carefully reading the 10Qs and 10Ks, we began to notice something. Based on their own metrics, management was killing it. But based on the GAAP numbers, their performance seemed oddly anemic. And with each passing quarter, the disparity between the two kept widening, with the GAAP-based performance continuing to be oddly feeble and well short of what I thought were reasonable expectations for their performance. Here's my spreadsheet on that math, which ran with the FT article. Next slide, please. So we blew out of the position. We sold it all. We made a nice profit, but of course the stock kept climbing. That's what always happens when you sell. We kept following it, and in June of 2022, they announced that with the help of several major Wall Street banks, they were going to raise about $600 million in debt. Less than 2 months later, Avaya slashed its forecast by 2/3 and fired the CEO, citing, quote, substantial doubt about the company's ability to continue as a going concern. The notes that had just been issued lost half their value, and a year later, the shares became worthless when Avaya went bankrupt. The investment bankers and those who purchased the notes predictably went ballistic, claiming they were defrauded, misled. But here's the question. How could anyone claim to have been misled when all the numbers they needed were in the public domain, readily available? There's a spreadsheet. That's all based on the filings. Even if some wrongdoing was occurring behind the corporate veil, you didn't need to be privy to it to see the train wreck coming. It was staring you in the face if you bothered to look. More on that in a minute. Next slide, please. Prior to launching our current fund, I was the CEO of a single-family office. And in that role, I built a position in a bank called Tier 1. We were well into the great financial crisis, and I came across it as I was looking for underpriced opportunities among the potential survivors. Not a huge bank, but the second largest in Nebraska. And although the share price had, like most banks, been crushed, Tier 1 had a remarkably healthy balance sheet, including its loan book. I dug deep into the numbers and even paid a forensic accountant specializing in financial institutions to check my math. Both of us came to the same conclusion. If the numbers were accurate, it was a great investment opportunity. So I flew out to Nebraska and met with senior management just to make sure I wasn't missing something. And the first thing I did when we got into the conference room was tape this sheet to the wall, and I've got a hard copy because it wouldn't really work as a slide, but just by way of visual aids.
Nice work.
That's a blow-up of a spreadsheet of every publicly available data point on their loans over the preceding 12 years. I pointed to it and asked, what am I missing? As we went through the numbers, they insisted all of them were accurate. The next time I pulled out that sheet, I was back in Nebraska several years later. It was in front of a jury. After getting a hold of my research, the SEC and DOJ asked if I could assist them in the prosecution of Tier 1's management. Now, a common complaint following the GFC was that not a single bank CEO went to prison. Next slide, please. Not accurate. I spent a week in Nebraska walking the jury through the numbers in the course of events, and following his guilty verdict, the CEO was sent to Leavenworth for over a decade. My closing comments. Now, Avaya and Tier 1 were two very different situations, but they had one thing in common. Anyone could have done what I did, and that's not false modesty or some kind of humble brag. Anyone with a basic grasp of accounting and financial reporting could have made the effort. Which brings me to my final point, and perhaps the elephant quietly lingering in the back of the room. Why didn't they? Why don't they? How we police financial reporting, including how GAAP and non-GAAP numbers are presented, is crucial. But to what degree does the investment community look closely at either anymore? To the extent that the investment process has been automated, with capital pouring into ETFs and other passive vehicles based on indices, themes, and exposures, the asset management industry has achieved impressive economies of scale. But in the process, they've effectively institutionalized complacency. Now, the more uninformed or indiscriminate money there is in the market, the easier it is for someone like me to identify and exploit security-specific mispricings. We've always relied on that profit incentive, focusing on individual securities to ensure that the market will, in aggregate, continue to efficiently, accurately price risk. Which is why the topics we're exploring and debating today are, in my opinion, so crucial. It may be fashionable to be dismissive of those who set the accounting and reporting standards and enforce them. But I know, based on what I do every working day, that we take them for granted at our peril. The buck really stops here. It really does stop here, as will I.
Thank you much, Stephen, for pinpointing how important this area actually happens to be. Next, we will hear from Vanessa Teitelbaum, Senior Director, Professional Practice, Center for Audit Quality. Vanessa is a certified public accountant and Senior Director at CAC. She advocates for stakeholders in the audits of public companies. As an in-house expert and resource on auditing and accounting practice issues, Vanessa leads task forces comprised of audit partners and technical experts from the public company audit profession related to proposed standards and other current issues facing the profession. I've been fortunate to work with Vanessa on a couple of matters, and so it's great to have you here to further inform us in terms of what your organization happens to be doing.
Great. Thank you so much, James. I really appreciate the opportunity to be here. So thank you very much. It's a hard act to follow. I don't have any tilt-a-whirl stories or giant blown up spreadsheets. No slides.
Sorry.
That's okay. That's okay. But I am happy to be here. And maybe just to build on especially Tim's grounding of non-GAAP and the regulations, I wanted to talk a little bit about the auditor's role for the online audience. And again, just to make sure we're all aware of those rules. And so there's three basic points I wanted to make. And so the current role of the auditor is, as it relates to non-GAAP, is that it's limited, that those are the rules right now. There is an auditing standard, a PCAOB auditing standard 2710 refers to other information, and that other information, the scope of what the auditor's responsibility is specific to documents that contain the audited financial statements. And then if those documents contain audited financial statements, there is we think of it as a read and consider requirement, which is substantially less than an audit. And we can debate if that is sufficient, but that is what it is right now. And so actually, just to specify what the read and consider means, it is to consider whether such information, this other information, which is not only non-GAAP, but non-GAAP as an example, consider whether such information or the manner of its presentation is materially inconsistent with information appearing in the audited financials or contains a material misstatement of fact. So again, the scope is, there's a lot of documents that are outside of the scope of the auditor's responsibilities. So press releases are outside of that scope. And so then the other point I wanted to make is the scope of ICFR, so internal control over financial reporting. Non-GAAP is not within that scope. And therefore, of course, the auditor's opinion over the effectiveness of ICFR, if the company is subject to 404B, it's not part of that assessment. It is important, I think, to point out that controls over disclosures and non-GAAP disclosures are within the broad scope of DCNP, so disclosure controls and procedures do exist, but it's a difference between that and ICFR, as this group is probably aware. But what the CAQ has done over the years, we've had a number of roundtables. It's been a few years now, but we've done roundtables, we've done stakeholder engagement to talk about the role of the auditor as it pertains to other decision-useful information. Non-GAAP is one of those examples. And there are a number of things that auditors could do if they were asked to do it by the audit committee, by management, and that would, in addition to the important role of the regulator and the preparer, it could add to trust in the information. And Stephen, as I heard your remarks, I agree with you. It's as long as you're not saying this, but if it's disclosed, you have the information you need. And so what is, for consistency, as Tim is talking about, it's useful for the regulators to have written guidance. It's useful for the SEC to be reviewing and providing comments. It's useful for the preparers to understand what is acceptable. And I would argue it's useful for the auditors to also assess perhaps more than they are required to do right now. So we've said, and we have publications on this on our website, www.caq.org. We have said that auditors could do certain procedures, attestation services. Auditors can look at the consistency of the calculations year over year for their audit client. They could look at the calculation input, certainly accuracy of the actual calculation, the adjustments and so on. They could confirm that the calculations are in accordance with the company's policy. They could assess give some input into the company's existing policies. They could be engaged to control procedures. And so that's something we as auditors are very skilled at, understanding the process for calculating the GAAP numbers. And you could, one could argue, you could look at the non-GAAP as well. So I'm going to stop there, but I think there is a role for a lot of different stakeholders to continue to make sure there is trust in the numbers and in the capital markets. And I just wanted to talk about, where the auditors can play that role. Thank you, James.
Thank you very much, Vanessa. Next, we will have Jeff Mahoney. Jeff hails locally. He's General Counsel of the Council of Institutional Investors. He advocates the Council's membership-approved policies before standard setters, regulators, members of Congress, and other policymakers. Prior to joining the Council, Jeff was counsel to the chairman of the Financial Accounting Standards Board, FASB. He also is a certified public accountant. Jeff, what are your thoughts?
Well, thank you, James, and other members of the IAC for the opportunity to participate on today's panel. As James said, I'm appearing here today on behalf of the Council of Institutional Investors. CI is a nonprofit, nonpartisan association with a core membership that includes U.S. asset owners with assets under management of approximately $5 trillion. Those member funds include major long-term share owners with the duty to protect the retirement savings of millions of workers and their families, including public pension funds with more than 15 million participants. These are true and real Main Street investors through their pension funds. Our associate members include non-U.S. asset owners with approximately $4 trillion in assets under management and a range of asset managers with more than $60 trillion in assets under management. It's increasingly common for large public companies to disclose adjusted earnings or financial measures that are not in accordance with generally accepted accounting principles. Recent research from Calcbench and Suffolk University examined the 2024 annual earnings releases for companies from the S&P 500. Study found that a total of 351 firms reported at least one adjustment to either net income or earnings per share. In total, there were over 2,200 adjustments with an average adjustment value of more than $135 million. And the average firm had more than 6 adjustments. So of the 351 companies, 89% had non-GAAP net income that was higher. 89% had higher non-GAAP net income than GAAP income by an average of $870 million per company. And it was about 30%. That's about 30% of GAAP net income. CII has long believed that the requirements of SEC's Regulation G and Item 10E of Regulation SK, that they provide very important investor protections against misleading information about company performance. We also believe that one of the most important provisions of Regulation G and Item 10E is that they require companies to provide a quantitative reconciliation of each non-GAAP financial measure from its most directly comparable GAAP measure. Yet, an anomaly currently exists for non-GAAP performance targets that are contained in the compensation discussion and analysis section, or so-called CD&A, of the company's annual proxy statement. When alternative measures of performance are disclosed for executive compensation targets in the CD&A, as they often are, companies are currently required to provide only a qualitative disclosure of how the target levels are calculated from the company's audited financial statements. They are in effect exempt from providing the otherwise required quantitative reconciliation of each non-GAAP performance target. CII acknowledges that alternative measures of performance targets for executive compensation may be very useful for incentivizing prudent executive decisions benefiting long-term investors. However, the bottom line is GAAP is still the standard, and we believe deviations from GAAP need to be clear and put in context through disclosure of a quantitative reconciliation of GAAP to non-GAAP, including for executive compensation performance targets in the CD&A. Investors often struggle to make sense of how companies assess performance in approving large and complex executive compensation packages. CII believes the need for clarity is especially appropriate because the CD&A of the proxy statement is the single most important source of information used by investors when evaluating executive compensation for proxy voting purposes. And shareholders cast advisory votes, non-binding votes on executive compensation on a regular basis, including every year at most public companies. A quantitative pay metric reconciliation of the non-GAAP performance targets in CD&A can also convey information about a corporation's governance more generally, which can also inform investors in deciding how to vote on the election or re-election of directors, including the chair and members of the Compensation Committee, the Governance Committee, or the Audit Committee. And finally, recent surveys confirm that most institutional investors agree that the disclosure of quantitative reconciliation of GAAP to non-GAAP should be required for performance targets in the CD&A, and, if required, could be a strong factor in their proxy voting decisions. CII has a rulemaking petition before the SEC that addresses this issue, and I'm hopeful that the Investor Advisory Committee will work with CII and the Commission and staff under Chair Paul Atkins to remove this long-standing anomaly in the requirements of Regulation G and Item 10E of Regulation SK. That concludes my prepared remarks. I want to again thank you, James, and the IAC for inviting me to participate on this panel, and I look forward to the discussion.
Thank you very much, Jeff. Finally, we get to Jose Rodriguez, Board Chair, CareMax. Jose serves as Chairman of the Board of CareMax. Prior to such service, he was a senior audit partner at KPMG, where he held various leadership positions, which included serving on its board of directors and as lead director, chief operating officer of KPMG's International's global audit practice. Jose is a National Association of Corporate Directors Fellow and has been included in NACD's D100 list, which recognizes the most influential people in and around the boardroom. Jose is currently on the boards of directors of Promore Services Corporation and Popular Inc. as well. So, going last, you've had the opportunity to listen to the other panelists. And so it gives you a great opportunity to basically share your thoughts in terms of non-GAAP as well as what the other panelists have said thus far.
They're all right. Well, thank you, James, for the and the committee for the opportunity to be here today. I do believe it is non-GAAP measures is an extremely important topic. I currently serve on the board of Popular Inc., a large regional bank, and along with Promore Service Corporation, a large infrastructure company. I have the privilege of serving as chairman of the board, as the chairman of the audit committee at Popular, on the non-gov committee, and on the risk committee. When it comes to Promore, I'm a member of the audit committee, I'm on the non-gov committee, and I'm also chairman of the compensation committee. So I get to see a very broad view of what is important in driving and decision-making. But when it comes to non-GAAP measures, I think the board of directors, specifically the audit committee, and you mentioned the compensation committee, I think all play an important oversight and governance role in the application of non-GAAP measures. It involves looking at strategic guidance and compliance with the requirements of the SEC and other regulatory bodies. But I believe that a board, specifically the audit committee, needs to have a clear understanding of these measures. I believe they need to review non-GAAP measures. They need to familiarize themselves with the non-GAAP measures that the company uses, understand how they are calculated, what they aim to convey, and how they differ from GAAP measures. Evaluation of the rationale. Ensure you understand the reason behind using non-GAAP measure. Assess whether these metrics genuinely enhance the understanding of the company's financial performance. Another key aspect is to ensure transparency and compliance. With respect to regulatory compliance, work with the finance and legal team to ensure that the presentation on non-GAAP measures comply with SEC guidance and other applicable regulations. For example, the SEC requires a reconciliation of non-GAAP measure to the most comparable GAAP measure. Clear disclosure. I think that you have an obligation to ensure disclosure around non-GAAP measures are clear and provide adequate context to investors. This includes explaining why these measures are useful and the specific adjustment made. Assess materiality and consistency. Consistency, I think, has been named by everyone across this panel. Ensure that non-GAAP measures are applied consistently over time to facilitate comparability. This promotes, in my opinion, credibility with investors and the analyst community. Materiality, I think, plays an important role. consider whether the adjustments made in non-GAAP measures are material to understanding of the company's financial condition and results of operations. Oversight for financial reporting, a key responsibility of an audit committee and a board. I believe that audit committees and board regularly need to review financial statements and presentations to ensure that non-GAAP measures are used appropriately and provide a true representation of the company's financial health. Engage with your external auditors. Though it's been mentioned here before, and I know it well in my past role, the external auditor has limited responsibility when it comes, or no responsibility, depends on how you read it, with respect to non-GAAP measures. But I would encourage audit committees to have a discussion with their external auditors and gain their views on the use of the non-GAAP measure and ensure there is an alignment in how these metrics are treated in financial reporting. Finally, engage with and interact with management. Regular engagement with management team to discuss their rationale for using non-GAAP measures is important. Understand how these measures inform strategic making decisions. So in closing, I do believe, as a sitting member of a public company board, that the board plays a critical role in the governance of non-GAAP measures and how these tools are effectively while maintaining integrity and transparency. Regular engagement with management, a firm understanding of these measures, and adherence to regulatory standards will enhance the company's credibility and foster trust among its investors and its stakeholders. So the board, in my opinion, and the audit committee do have a role in how non-GAAP measures are used. Thank you.
Thank you very much, and thank you all for your perspectives. I want to mention that in the room we have an IFRS board member, Zach Gast. IFRS has recently entertained looking at how they view the overall financial reporting system, and it proposed some changes to their overall system, which includes GAAP and non-GAAP and KPIs. And so basically, in response to what investors want. And so in examining the US-based system, from your perspective, panelists, what is the overall effectiveness of our system? More specifically, how effective are Regulation G and Item 10E and the guidance that we currently go by in operating under non-GAAP?
So I can kick us off, James, and thank you for the question. I agree. I think, both in the U.S. and internationally now, the standard setters have begun to introduce non-GAAP measures into the accounting standards, right? We had segments where non-GAAP measures are now permitted in the U.S. to be provided in the notes of the financial statements, and IFRS 18 has come out, which will be effective in a few years, which enables or requires the disclosure of non-GAAP measures when they're used outside of the financial statements by that entity. If we kind of ignore, I guess, maybe the question of once you put non-GAAP into GAAP, is it still non-GAAP? That's a conundrum. I think from my perspective, Regulation G and Regulation SK are effective. I think that the guidance that the staff has come out with is effective. As I kind of alluded to in my remarks, I think where we could build on kind of the guidance is really better communication, maybe additional guidance and better clarity for preparers, right? I don't want to downplay, I know a number of folks have made remarks about the auditor's role in non-GAAP. I always say we're involved with, though we're not associated with non-GAAP measures, right? Non-GAAP measures are GAAP plus or minus other GAAP to get to non-GAAP, really, at the end of the day. So we know GAAP. GAAP is the language of business. and we know GAAP. So, we advise very frequently with our clients and with companies on non-GAAP measures. I talk to the SEC staff frequently about, their misgivings about non-GAAP measures and not understanding why companies can't get it right in their view as well. So I think on both sides, we've got folks that are confused, and like I said, I think better communications would help improve things.
So Jeff, I'm looking to you. Do current regulations sufficiently protect investors from misleading non-GAAP reporting?
Well, James, at CII, we've always been a big supporter of Reg G and Item 10E. Throughout my entire 19 years at CII, we've always been a big proponent. I think consistency is very important. As I mentioned, I think the quantitative reconciliation is very important. Also, the disclosure of how this benefits investors, I think that's critically important. And with any area of reporting that's important to investors and others, I think the enforcement is really critical. My experience as an accounting, working in accounting standard setting for 13 years tells me that if a standard is important and it's not enforced aggressively and rigorously, the value of that standard will decline over time. So I'm not saying that Reg G and Item 10E are not rigorously enforced, but I think it's important that they be rigorously enforced. That's a key element of making these non-GAAP numbers relevant and valuable to investors.
James, do you mind if I just respond for a minute? Jeff, I don't know if you mean enforcement with a capital E. I would argue enforcement is important, and perhaps you meant this anyway, but like monitoring. Right. So as Tim was talking about the SEC, CorpFin review and comment letters, I don't consider that enforcement necessarily, but obviously those comment letters are public. I think that puts a lot of the general public and certainly preparers on notice. So to me, that monitoring, not tech, is also important. And I didn't know if maybe you meant both.
I agree. I meant both.
Yeah.
I think the fact that it was mentioned earlier that that's one of the top comments made by SEC staff, that's reassuring to me, because given the importance of this information and the regulation around it, the fact that the staff is paying a lot of attention to it, I think that's a good thing.
Thank you much. And Jose, what are the biggest compliance challenges companies face regarding non-GAAP disclosures? I mean, the board is in fact responsible, and I think you have eyesight on what those challenges might be.
Well, I think as far as compliance, I think the challenges are appropriately laid out, in my opinion, in Reg G and some of the interpretations. I think the bigger challenge from a company's or from a board perspective is the understanding of the whys these non-GAAP measures are being used. Are they really a key indicator for what? And what are we using them for? To me, that's probably the biggest challenge. Another big challenge is industry. So depending on the industry you're in, there could be a whole category of non-GAAP measures that are just become industry standards. And whether or not, as an individual registrant, you get a comment, you deal with them, your competitors are not dealing with them. That becomes a business and real challenge. So I think challenges come from external, challenges come from internal. I think, the board or the audit committee, has more control sometimes over the internal challenges and driving management, but it's hard to push back sometimes when the industry is using a set of KPIs or non-GAAP measures. And to me, that's where a challenge is. So when the SEC takes a position on an individual registrant, should they put a wider lens on it and start looking at the broader industry. And I think that's how you're going to drive different behavior in the long run.
Yes, Stephen?
Just to follow up on that and tie it into a comment that was made earlier, I mean, I think we need to see the forest for the trees in that we have an excellent system. It's the envy of the world. And I think for the most part, it's entitled to that interpretation. In the same way that, you don't turn on the news at night and have the first thing that they announce be how many people weren't murdered that day. We can take for granted how efficient the system is, generally speaking, on the whole, day after day after day. By the same token, Jeff's comment earlier, and he was talking about the disparity between non-GAAP net income and GAAP net income and how often, in terms of the frequency and the amounts, non-GAAP net income exceeded GAAP net income. I didn't hear any gasps in the room. We all understand it's what we expect. And so it's the presentation of that information. I think that there's always room for improvement. And there may be some space there in terms of some sort of mechanism between the investment community and the SEC and the regulators for resolving those disparities in a public way. I come across these disparities all the time. It's oddly enough, when I'm on calls with companies, they're somewhat reticent when I raise these issues. But the regulators are in a position to, let's say, for example, compel a clarification that's raised by the investment community and is shared in a very public way so that all investors benefit at the same time in the same way.
So I'm glad you brought that up, and I want to ask a more general question. Do existing regulations effectively deter companies from misleading non-GAAP disclosures? I mean, I guess, Stephen, you would say, you have some practical examples where it didn't happen, but I think what I'm getting from other panelists, in the main, companies are doing it correctly. And so in that context where, in the main, companies are doing it correctly, however, we have these outliers who are basically doing some things that obviously shouldn't be done, do the regulations act as a deterrent? I mean, or what are your thoughts on the deterrence effect now in existence?
Well, again, what I said in my comments earlier wasn't an indictment. I think that they're offering non-GAAP metrics because they put a more positive spin on their performance. But I don't view that as they're trying to necessarily fool anyone in a game where everybody should know what the game is. And I also don't think that they particularly want to go to jail. Again, for the most part, our system is very effective and efficient, and that includes the deterrent function as well.
Yes, Timothy?
Yeah, I think that's a very important point that you make, Steve, and I agree. I think for the vast majority of entities out there, they intend to do the right thing, and they're playing it within the confines of the rules as they stand right now and as they're enforced. And look, these comments are like, penalty flags being thrown on the field, when they violate a rule. The intention isn't there to mislead, but they do. Some companies do happen to kind of violate just the basic tenets, and the SEC is there to monitor, as was talked about earlier, and try and correct those those errors through the filings. So I do think that the system is working. And to one of the earlier points too, I think I have seen companies have non-GAAP measures rejected where they're excluding expenses because the staff will come in and say you're not thinking about the associated revenue, and therefore it's misleading. You're not adjusting both the revenue and the expense measure in a fair, unbiased fashion in order to present an appropriate non-GAAP measure. So I do think the monitoring program is working.
James, I would agree that I do believe the monitoring process is effective and is working. I think companies try to do the right thing in absolutely the right way. You'll always have outliers, but to Tim's point, the flag is thrown. You do get comment letters. Comment letters are sent out questioning non-GAAP measures. I think the transparency and the comparability, I think, is an important factor. I don't always see non-GAAP measures being a positive or an increase to the bottom line. I see them being used also when there are unusual transactions that give rise to unusual income in a given period, and they are adjusted. So not only is it a valuable tool, but I do believe that the enforcement as we have it today is appropriate, is effective for the majority of companies.
So that's good to know, but if I look at it critically, I still see some problems. And some of them appear to be somewhat basic that the system should have overcome by now. And so I'll ask this question. Should the SEC introduce standardized calculations for widely used non-GAAP metrics like EBITDA, free cash flow, or KPIs? And then how could FASB contribute to this effort? And so, I mean, I think the EBITDA is a commonly used, but depends on whose hands it's in, you could come to get different conclusions. So what are your thoughts?
Yeah, I think that's right, James. And I think we would be supportive if the SEC staff were to come out and say, here's a current list of these types of adjustments where we think these are reasonable adjustments to make. Again, coming back to kind of my main point that I think communication between the constituencies is important and making sure that everybody understands the rules of the game, as we've been talking about. Having something like that out there could be useful. Having an approved list might be useful. And we've seen that in certain circumstances. As I mentioned during my remarks, we have industries where there's certain, like just generally approved non-GAAP measures that are used. FFO is a good example of a non-GAAP measures that's generally accepted, forgive the term, by the SEC.
It's fund from operations in real estate.
Yes,
Yeah.
that's right. So, to the extent that the standard setters want to bring this more into the mainstream and into the fold, I think that we leave that to them. Obviously, we remark on any rulemaking that they propose. But like I said earlier, we've already seen a couple of standards come both domestically and internationally where that's starting to be the case.
I mean, fundamentally, aren't non-GAAP measures potentially infinite? I think he made a really good point, actually, because it's, and what you described is sort of generally approved non-GAAP measures.
Yeah.
So there's sort of, with this quasi-category where I think regulators could stipulate how that's actually calculated so that it's common practice. But the extra information that you get from non-GAAP often is available. You get, if you gather any insight from it, it's because it's bespoke to some extent and particular to that business. And again, I'm not assuming, I say that because I'm not assuming that this information is offered to mislead frequently, even if it does tend to put a more positive spin on these companies. There are some where it's just another metric. FFO is a great example.
So going along that same line, and I'll let you come in, Jeff, is it difficult for users to distinguish between standardized or audited measures and those that are non-GAAP? So Stephen, you offered up, non-GAAP may in fact be infinite, but much of that is not problematic. I mean, what becomes more problematic are non-GAAP financial measures that are represented and have the same materiality and value as GAAP measures, and then are presented in a way that you want to make the investor believe that these measures are more important, and the sole reason you want to do that is because you look better, not because it's more relevant. So, Jeff, what are your thoughts?
James, I was just going to mention, you mentioned the FASB, so I spent a number of years there, and one thing that I recall is when we did earnings per share as a standard. That was really like the first metric, financial metric that the FASB put into GAAP. And a FASB chairman I worked for, he said that was the biggest mistake the FASB had ever made, and as long as he's chairman, they're never gonna do another metric in GAAP again. And he explained that, well, once we put that out, and it was EPS was something that was closely followed in the market and drove market prices. So then what happened is everyone tried to find ways to manipulate earnings per share to make it higher. And so we ended up putting out guidance after the fact to try to limit the manipulations. And eventually that guidance was about this thick. And so when you're a standard setter, but you don't enforce the standards, you have to remember that a metric or any piece of financial information that's GAAP that drives the market, there will be rotten apples out there that will continually try to manipulate that item. So if I was at the FASB, I would have to think long and hard as to whether I wanted to produce more metrics, because that situation is very likely to occur again. I mean, we had an SEC back then. We had enforcement, we had auditing, and still EPS was constantly manipulated by companies because it was so important to driving the marketplace. So it's just a consideration that a standard setter has to think about when they don't have control over the enforcement of their own standards.
I don't disagree with what necessarily with what has been said. I think there are probably a set of commonly used non-GAAP measures that fences can or put around. I think it's very difficult with coming up with all the KPIs that may be important or drive business decisions within a company. But I'll go back to, or by analogy, is following the North Star. To me, the purpose of non-GAAP is not to put your company in a better light or create more income, is to actually portray what is driving that company, what is important, and how investors or stakeholders can better understand a company. But is that North Star, and I think the majority of companies do follow that North Star. And that's kind of my goalpost, is looking at it that way as a board member.
So I think it's interesting you bring that up, Jose, because I did read a research article, and one thing it's easy to do is find research articles on non-GAAP. I think for practical reasons, it's heavily researched because of how important it happens to be, and you don't have a standard setter, and it's not highly regulated. So basically, what I found in Qualitative Characteristics of Non-GAAP Disclosures and Non-GAAP Earnings Quality by Chen Li Lo Yu, they essentially agree with you. But in their research, what they find out is that the more transparent qualitative non-GAAP information is associated with higher non-GAAP quality. So basically, if companies are in fact forced or compelled to explain what you're doing it and why you're doing it, they're less likely to be more opportunistic when they provide the quantitative number. So I thought that was incredibly interesting. Since this is an IAC and we're focused on investors, I want to get back to investors for a moment. And that is, how important is non-GAAP to investors? Stephen, you mentioned it in your presentation, but I want to explore it a little bit. We're talking about it here, but basically, are investors really focused on this incredibly important information?
Not to give you a lawyerly response, but which investors is, I think, an important question to ask. When I see non-GAAP, again, I don't necessarily assume that something that is inappropriate is going on, but I also understand the intent. I mean, if you're if you're looking at a house to buy and they're walking you through all of the rooms and they say, but don't look at that one. You know, I'm going to look in that room because they're wanting to, it's a distraction. They're trying to get me to focus on other things. If the non-GAAP numbers are at least consistent and the GAAP numbers are dependable, per what I kind of talked about in my presentation, that disparity can reveal a lot. And because non-GAAP numbers are potentially an infinite opportunity set, I don't see a problem particularly with that. I mean, trying to police something that is constantly evolving and growing is relatively impossible. To police or enforce the consistent and accurate presentation of the metrics that you've generated that you want to use, I think that's doable from a regulatory perspective, and I think it's really important. And I also think that one of the reasons it's important is because if you see a departure from that consistency, they drop one metric or they start measuring it differently, that's clearly indicative of something, almost always.
One of the other things that could be considered around those lines is all the GAAP numbers are subject to controls of some sort or another. I would expect, or I would hope, that when you have, or there should be, if you want to make a recommendation, is that there be adequate internal controls around the development of non-GAAP metrics. So to your point, whether you can trust those numbers or not, right now, one of the key, under Sarbanes-Oxley, is you have to have an effective system of internal controls, which the CEO and the CFO, certify every year. They don't certify to controls over non-GAAP measures or their consistency or anything else around them. That is something that could be considered.
Just to respond, I mean, by way of follow-up, think about how not suspect the freakish consistency of EPS performance was in a huge number, I mean, a remarkably large number of the most respected companies in the world, General Electric, AIG. The accounting gymnastics they went through to deliver quarter after quarter, and that was GAAP. And as far as, and I waded into those filings and the footnotes, and it was, as far as the non-GAAP stuff and how they interpreted or explained how they arrived at some of their GAAP numbers, it was Esperanto. I mean, those companies, all of them, their primary asset, and this is a good lesson actually for the market overall, was the benefit of the doubt. Nobody asked, because these are the gilt-edged stocks. And per kind of what I talked about in my presentation, I think it's a very short trip and a direct line between the reliability and the fidelity of the numbers on an individual level and the trustworthiness of the market overall and our cost of capital and the desire of other companies to list here as opposed to anywhere else. I mean, that cost of capital does not have to shift by very much for it to result in billions, hundreds of billions of dollars. So it's something we should really endeavor to protect and exercise every effort to do so, including, again, the GAAP. A lot of companies that had no issues, there were no questions about their GAAP accounting, and the statements were GAAP format, but we know what happened.
So yes, next I want to hear from Timothy and Vanessa on this question, but I will open it up to other IAC members after this particular question. So we do have the case in which GAAP financials are in fact audited. Non-GAAP financials are not audited. But in many cases, for many industries, those non-GAAP financials are more important than GAAP. And so what are your thoughts with that? Should non-GAAP be at least assured, or should we get more solid verification on the non-GAAP numbers? What are your thoughts, Timothy?
Sure, thanks for the question, and I might just back up to your basic premise there. I do think that GAAP is more important than non-GAAP. As I said before, GAAP is the language of business. My former partner, Jose's former partner, the former chief accountant of the SEC, Paul Munter, made those remarks numerous times. And I truly believe that. And I believe GAAP is an important way to communicate. And I think maybe to Steve's point, and he didn't say this in his remarks, but that information is always available, right? And to the point where non-GAAP measures are really GAAP plus or minus other GAAP, to get to the non-GAAP, GAAP still wins the day. Now, I think, look, if you think about language evolves, right? There's different dialects, there's slang, there's different ways that people communicate, and non-GAAP is really a diversion off of that language of business. Certainly, I believe that GAAP is most important, and the way I look at non-GAAP is another way for businesses to communicate their story to their investors. Obviously, they're going to try and do that in a way that makes sense, in the way that they're running the business, in the way that the numbers are playing out for that period. Whether or not the numbers need to be assured, I think that's from my view, that's a question for the investors. What is needed from us as a profession, and I think we're ready to serve that. But maybe Vanessa, you can get into that a little bit more as well.
Thanks, James. Tim, I would agree with you. I think the auditing profession can play a role. I think we've said repeatedly through the CAQ and others that we definitely have a skill set and we could help review for consistency, compliance, like I said before, with policy. Whether it should be regulated and mandated is a hard question, I think, to answer. I think regulation in general is rarely one size fits all. I think it's really important to do a robust economic analysis to determine if that would be, if the benefit would exceed the cost. So is there a problem right now where it would be needed? I mean, audit committees, I think, should consider it. Is there a reason for their company? Are they new? Are they a new public company? Maybe their finance team is less familiar with Reg G. Maybe you engage your auditor in that situation. I had a client years ago. It was a new public company. I don't think they had heard of Reg G. So, many of us with a lot of experience, can help, even though it's outside of the auditor's responsibility. But obviously, we want to be helpful to our clients. So I think there is a role to play, but I think it's, to jump to for something being mandated would require, I think, further consideration.
And when we think about that further consideration, in your opening, you spoke of other information. So basically, the regulation for other information came into being in the 1970s. At that point in time, there was virtually no non-GAAP. Non-GAAP became prevalent in the 90s and has essentially exploded since then. So given that we're operating with something from the 1970s, looking at information that has become substantially more important, does it make sense to see whether there's something, and I agree with what people are saying, it's not a matter of heavy-handed enforcement, but could there be better guidance, or could the people with the best expertise play a larger role? Yes, Stephen.
I'm going to rephrase your question in an unfair way. Do we need to protect investors from themselves? We know that the gravitational pull of the GAAP numbers will ultimately prevail over whatever non-GAAP numbers would present, that the GAAP is the standard. If that's the case, then, and fundamentally, it dovetails with a lot of what Tim was saying earlier, we don't need non-GAAP anyway. Do we need to regulate something that is ultimately unnecessary? Are we asking that question because we need to protect investors from being distracted by it? And then which investors? How much are institutional investors being influenced by these numbers when perhaps they shouldn't be?
Thank you very much. And now we'll move on to a question from Colleen.
Oh, thank you. So I have a fairly short two-part question and then a longer question. For the shorter question, are any of you aware of evidence on whether investors are aware that non-GAAP is not audited?
I personally can't say. I'm not aware of research, but I haven't looked for it.
If you,
I would just adding on to that, I'm not aware that they're not aware, but I don't know how I'd figure that out, I guess. But I guess what I'd say is that our audit report is our one, document and deliverable to the investor community and to our clients, and that in no way insinuates that we've audited non-GAAP.
yeah, I'm not, blaming you by any stretch. But I'm just thinking if I'm reading it through Cap IQ or something like that, is it really distinguishing? And, at least anecdotally, when I've spoken with investors, many of them have been surprised to learn that, non-GAAP is not subject to the same level of audit. So I'm curious if there's, systematic evidence on it, because I've looked for it and haven't been able to find it. But then the second part of that is, for the investors who are aware, have you seen investors actually asking for non-GAAP to be audited?
Not personally.
Clarified, absolutely clarified, but not audited.
Professor, in my 19 years of CI, I don't recall a single phone call from a member saying that they want non-GAAP audited. Maybe I had one and just forgot it, but no.
Is it possible that it's because they assumed it was in fact audited based upon how it was presented, and that some investors can't actually distinguish the two?
Absolutely. Yeah, that's possible, for sure. I mean, investors are not a monolithic group, as was stated earlier. So, I'm sure many investors, there's probably some that think everything's audited, and others, probably the highest percentage would say we don't know.
But it's not audited. We're agreeing with that. We're all, I think that's clear, but it is regulated, right? That's what we've been talking about today. So there's some governance in that way, and hopefully the audit committee and the board are also exercising oversight of it. So it's not completely, hopefully, the wild, wild west.
That's an interesting point, though, the way you put it. It's regulated but not audited. How do you regulate something that isn't audited?
Well, I just mean there is regulation. There's regulation. I don't know. What do you mean?
As in, we regulate these numbers that are not checked, and we're not sure about their accuracy.
Well, I just mean there's
but
principles. The Reg G has the principles that I think the preparers adhere to, and there are the comment letters, so.
And I think that's important. Because part of it, the answer is, the pre-existing answer to a lot of these questions is, there's a general oversight, and it's not more specific than that, because, I think this applies to a lot of the regulations, particularly the 34 Act. There's, dare I say, a deliberate ambiguity to a lot of it, which gives the SEC latitude to be able to enforce where they need to step in when they need to, because they're going to encounter situations that they hadn't anticipated because the market's constantly evolving.
Thanks, good point. Yes, Brian.
So following up on that question a little bit, Vanessa, sort of targeted to you, but thinking about industry-wide or where you have a metric which is used across, a whole industry, should there be something short of an audit of those industry-wide metrics, regulated, clarified, some sort of way so there's consistency, so that everyone in the industry is using it in the same way? I'm not saying audited in the sense that it's going to you, Timothy, but is that one way of parsing through all this? It's one thing if a company on its own comes up with some crazy metric, but if the entire industry, whether it's the financial services industry or whether it's some sort of manufacturing or pharmaceutical, whatever it happens to be, right, that there is a consistent metric that every analyst, every, informed shareholder asks for. Do you do something with that metric?
I mean, I think personally, maybe that is a better question for investors. I think if investors were to say yes, the auditor, could do that. I think, I don't know what Tim and Jose think, but so I think the auditors can stand ready. Whether we should, to me, would depend upon the usage and the views of the investors.
Yeah, I guess I would say, Vanessa, in response, you need to have a framework to audit against, right? So if there's no framework, we cannot audit it. So when there are disparate definitions of different measures, it's not in our it's not our purview at this point to say that this meets some standard, because that standard doesn't exist.
I do believe that, Tim, on an individual company basis, the standard is consistency and transparency on them. And I think that's a role that a board and audit committee needs and should play.
I agree. And Jose, would you say, I assume this, but I'll ask the question directly, do you talk to your auditors about non-GAAP measures?
Every single time. And we, at least on the audit committees that I serve, we do take their advice. But besides the auditor, one of the people that one of the most influential person when it comes to dealing with non-GAAP disclosures is the attorneys. And whatever the attorneys or the legal firm says will trump whatever the auditor thinks. Because at the end of the day, Reg G is a law. It's not an accounting standard. So when you're having these discussions, the other important player in all this is legal counsel. Who's your security counsel? What are their thoughts? I challenge audit committees to ask that of securities counsel.
But who's running the numbers for those security counsel?
It's the company. The company is the one that presents, the company is the one that has the numbers, but whether or not they comply with Reg G, SDNI or whatever, and the language used, companies rely an awful lot on the advice of securities counsel.
Brian, in answer to your question, we have a policy that indicates that many investors view industry or sector-specific information as particularly useful to them. That said, if everyone in the industry fully and faithfully complies with Reg G and 10E, isn't that sufficient?
That faithful compliance is interesting, given that we live in America. And the point I'm making is that when given the opportunity to make yourself look better, you will. And so I'm faithfully complying. I'm not going to, an accurate compliance may mean the numbers may look worse. But given that I know I did a great job, I'm going to make the numbers look good. Yes, Stephen?
To Jose's point, which I think is an important one, I was waiting for the moment when they would lower the bridge and let the lawyers into the room. The lawyers before the fact is what you're really talking about, but we also, have our beloved plaintiff's bar that never hesitates to go after these situations after the fact. The problem is that it is after the fact, and that is, within the industry, that's a pretty effective enforcement mechanism that we have that is outside of the regulatory framework, but is very effective.
But if you know the company is bad, and you could basically take another shot, give you another 12 months to maybe turn things around before anybody finds out. So it's like I can be honest today or be honest 12 months from now.
If I have a short on that company and I call the SEC, what is typically the SEC's response? That's part of the issue. For me, again, I firmly believe in the critical role of people doing close analysis of companies to keep the market overall efficient, but how does that information work its way into a market? How does it find its way?
I guess, James, just a quick comment. Based on our discussions with stakeholders in our roundtables, and I think we've said it today, I mean, we hear that there's non-GAAP can serve a useful purpose. So I would personally caution a little bit about even though there are bad apples and there could be instances of abuse, I don't think we are saying that necessarily it is the intention of preparers to mislead. And so I don't think, I would caution against that characterization. My audit client years ago always had this recurring, well now, on a temporary basis, adjustment because they had this very unusual legal settlement with a trust, and it dragged on, so that's why it continued. But it was non-cash, and anyway, it wasn't good or bad. Sometimes it went up and sometimes it went down, and but it was consistent until that transaction was finally settled. So, they just were they were constantly discussing it with the investors, and they just were pulling it out because it was unusual. And then, like I said, it took like 5 years to resolve. So there's just a lot of different circumstances, I think, and it's not necessarily always, I think, intending to to be misleading. I mean, hopefully.
And I appreciate that, and I think the panelists overall agree. But there is the case when markets are good, and so you have a system that you may not see any problems with it when markets are generally good. But if things turn and the system isn't adequate, you may see more challenges. One more question, Andrew?
Yeah, I'd be curious for the panel how you distinguish different types of earnings adjustments. Vanessa, you mentioned, obviously one of the most common ones being the exclusion of, let's say, normal costs or just these one-time expenses that we find are in fact recurring, right, due to maybe different various reasons. But I'd be curious for the panel how you think about some of these areas, these revenue earnings adjustments that are a little bit more gray. And what I'm referring to is, for example, if a company is, let's say, acquiring another division of a company, for example, right, or there's a merger. And then, obviously then we start to bring in this kind of pro forma, right, this kind of projection of potential cost savings, for example. So I guess, how does the panel look at and evaluate whether, how should we think of, projections that are actually, if they miss, right, that's, just unexpected versus a bad faith kind of projection? How do you kind of distinguish between that type of discrepancy?
I guess I'll start. I think the first answer is in a very ad hoc qualitative fashion. And that's one of the reasons why we have some issues that we do. And I think it's important, per Vanessa's point, to distinguish between a characterization and a mischaracterization. A lot of non-GAAP is them trying to characterize their performance in a certain way. Pardon me. But you're talking about like an acquisition and you say, okay, they're kitchen sinking the accounting. As long as you can see that, it's about the visibility and consistency and the transparency. Are there the adults in the room that are doing the math? And I think one of the problems you have, we have a very efficient market that people are wondering. You see, like with value investors now, you see a lot of people talking about how value investing is less effective. And part of that, their argument, and there have been studies, AQR did a study, because it takes longer for those mispricings to correct because not enough people are doing the math. And not enough people are doing the math in many respects. Again, the business has been very heavily institutionalized. That requires an ad hoc qualitative analysis case by case. And if it can't be automated, well, most of the entities running most of the money in our financial market are not interested. That's not the way they function. Even the approaches that claim to dig into the financials and look at valuation, it's usually factor-based. And they're looking at they'll come up with an algorithm where it's a price multiple of earnings, of cash flow, of free cash flow, of book value. The price is self-evident, and the value of all the other factors, whether it's cash flow or earnings, those are highly qualitative. But they're just plugging in the numbers. Which goes back to why GAAP is so important, because they're not checking the numbers.
So one final question, and I think no panel being, oh, you had another one? Okay, I'm sorry. Go ahead.
Is it my, okay, thanks. So I had actually the question I was going to ask earlier, which, but James tried to cut me off. So, so in academic literature, a lot of times we actually find that the market responds more to the non-GAAP numbers than to the to actual GAAP numbers. So it does seem like there's, at least in some industries, really incremental information in non-GAAP. And I'm curious if you guys could talk a little bit about what that information might be. So Stephen, I loved your discussion of the comparison of the GAAP and non-GAAP. I'm going to use that in class because I can see how that's really incremental information. And Jose, also when you were talking about non-GAAP and sort of those transitory situations, I can see where that's helpful too. But are there other broad categories where you would say non-GAAP information provides incremental information? And the reason I ask is really, first, I think that's helpful for FASB in terms of thinking about accounting standards. But also, I think it's helpful for the SEC, because when we, in academia, we refer to all this sort of CDIs and comment letters as like the non-GAAP GAAP, because some of them are pretty specific. And you'll look at some of them and it's like, this company has to remove their licensing expenses. And they're, you know, very specific about how you can do it. And it is almost like we have GAAP, then we have non-GAAP, which is to some degree also kind of standardized and, you know, to some degree, or I think for some people would say overly restrictive in how it's calculated, and what you can and can't say. And then, you know, how do companies really fully speak? And it makes sense, the SEC would want to restrict anything that could be, you know, give a false impression. And so I think we're all very supportive of that. But also you want to balance the ability for companies to provide that incremental helpful information with the need to avoid anything that's misleading. And so I think it's important also for us to really understand what incremental information non-GAAP can provide and sort of some categories of that, if you have thoughts.
I think the incremental information is as important as you're susceptible to it. You know, you know what management wants you to focus on. You know, you'll get on a call and the CEO will say, well, we've got your financials, but we really think this explains how our business works better. And I heard that sentence, and that sentence is coloring everything that follows. And if I make my investment decision based on that, rather than the GAAP financials, or I don't look at the financials in light of comparing GAAP to how they're trying to get me to interpret those numbers, well, whose fault is that? Again, I think there's sort of this penultimate question of how much of an obligation do the regulators and other entities, how much of a responsibility do they have to protect investors from themselves, and which investors? You know, particularly the institutional investors, if they're not thinking about what's being said and seeing it through the appropriate lens, what are they doing? I remember when you know, the Enron disaster occurred, and one of the big asset managers, part of his defense was, well, I never read the 10K. And it's kind of surprised me. I don't want to take the conversation in a different direction, but you know, there's no reasonable person standard for investment managers, for fiduciaries, at all. In so many other areas, in professional spheres, in specific professions, whether you're a doctor or the law will impose a reasonable person standard. There is a minimum you have to do to avoid liability, to avoid punishment under the law. But we have people who are running a lot of money, and they apparently don't have to read the 10K even if their firm put, $480 million into a company.
Stephen, I'm curious, are there any, I'm sorry, not to get off your question, are there any non-GAAP metrics or adjustments that when you see it at any company, it raises a red flag as to whether, you should trust other things this company's saying, whether you should trust their GAAP? For me, when I see a company adding back stock compensation, that raises a red flag for me. And I begin to wonder whether there's, other numbers that company is providing that aren't credible or accurate. What do you think?
Yeah, it's kind of a long list. I think for example, anything, and this was the case with Avaya, they had another version of revenue, annual recurring revenue. It was a very interesting metric, and it was interesting how, based on that metric, again, they were just doing an extraordinary job, but revenue overall just didn't seem to budge. How can one thing called revenue be increasing and GAAP revenue not? So if you read a lot of filings, which I'm reading them, all day, you start to see these things. And I think you also develop kind of an intuition for them. But it's all right there in plain view.
Right.
And final question. I don't think you can have a panel nowadays and not ask the question, would AI help? Quick thoughts.
Who's it working for?
Investors.
Are companies not allowed to use it?
Everybody's going to use it.
Because,
Look at it from the investor perspective.
So, then if I can use AI to accelerate or analyze the financial statements and the company can use them to generate them, you turn on your ChatGPT and say, well, how can I legally put the most positive spin on these financials? If everybody has AI, then everybody has AI.
I think there is a tool that does a sentiment check, and it can assess positive, negative, tone, and language. I've seen a demo on this. I mean, one of the things I would say, James, I'm not an AI expert, but we are working with a task force of AI experts, and so thinking about the role of it in auditing, and as I think most people know, my concern is obviously hallucinations. And so when I try to use it in my own life, it's not usually that accurate. So there's a difference between automation, I think, which is already very much involved in the financial reporting. So if it can be good, if it can accelerate analysis and it's accurate, then you can have more time, I would think, to look for the anomalies and, but we always say there should be a human in the loop. So I think there's opportunity and risks, kind of like everything.
Okay, thank you all very much. This has been an exciting panel. I've learned much. I would like to thank Colleen Honingsberg and Amy McGarity for helping me with this panel. And I also would like to thank Eduardo Nessi in his doctoral thesis, Non-GAAP Disclosure, Opportunism, Regulation, and Standardization. He sent it to me a couple of days ago, and I found it incredibly useful in thinking through the entire framework. So, and most of all, I want to thank you panelists for giving of your time, your expertise, and giving us some food for thought. Thank you much.
Thank you. That wraps up the Q&A session for this afternoon's panel. Again, thank you all of the panelists and participants for sharing your expertise and perspectives. Our next order of business is going to discuss a potential recommendation of the Disclosure Subcommittee regarding the use of mandatory arbitration clauses by registered investment advisors. Christine?
Thank you.
Arbitration agreements have been almost universally used by brokerage firms following the Supreme Court decision in 1987, which allowed the use of such agreements. There's less information about the scope and use of arbitration clauses by registered investment advisors, although we know from the SEC that 61% of the contracts they reviewed included arbitration clauses. Concerns surfaced in 2008 following the financial crisis, and as part of Dodd-Frank, Congress amended both the 34 Act and the Investment Advisors Act in response to the concerns that mandatory pre-dispute arbitration is unfair to investors. Congress gave the SEC the authority to prohibit or impose conditions or limitations on the use of such agreements by both brokers and investment advisors. Congress again expressed concerns in 2022 and asked the SEC to gather information on how such contracts are used by SEC-registered investment advisors and the effect such contracts have on investors. Today's recommendation regarding the use of mandatory arbitration clauses attempts to address these concerns and follows a panel discussion before this committee, which was held on December 10, 2024, entitled Examining the Use of Mandatory Arbitration Clauses by Registered Investment Advisors. At that time, the committee heard from Stacy Puente, who was the Ombuds and Assistant Director of the Office of the Investor Advocate here at the SEC, Kevin Carroll with SIFMA, Robin Traxler of FSI, Adam Ghana, the President of PIABA, and Stephen Bray, who's with the State of Michigan. The panel's focus was on the use and scope of mandatory arbitration clauses by registered investment advisors and the impact of such clauses on investors. The panelists discussed the use of mandatory arbitration clauses by registered investment advisors and compared that use and the contents of those clauses to those used by brokerage firms. Ms. Puente specifically discussed the details of a 2023 study issued by the SEC's Ombuds Office in coordination with the Office of the Investor Research and the Investor Advocate Office of General Counsel, which was in response to Congress's request for a study. The panelists also discussed the costs, concerns, and benefits of pre-dispute arbitration clauses. The subcommittee acknowledges that arbitration may have some benefits, including the speed with which disputes may be resolved, that there may be lower legal costs over the course of the dispute, that decisions are generally final, and that the process may be kept private if the parties so wish. However, those benefits must be weighed against the costs and concerns. As discussed during the panel, the cost to access arbitration venues can be prohibitive. Venues are at times designated that are far from and have no connection to the investor, and terms may be included in the arbitration agreement that inappropriately limit the liability of the investment advisor or otherwise benefit the investment advisor at the expense of the investor. As noted during the panel by Mr. Carroll, investors should have the benefit of a conspicuous arbitration clause that puts an investor on fair notice that future disputes will be resolved in arbitration and have access to an arbitration forum that provides prompt resolution of disputes, fair and transparent procedural rules, and fair outcomes. To a large extent, that is what investors are getting when they work with a brokerage firm pursuant to FINRA oversight. The committee recognizes the lack of parity with respect to the regulation of the use and scope of pre-dispute arbitration clauses by investment advisors and brokerage firms, and is presently making 4 recommendations with respect to the use of pre-dispute arbitration clauses by SEC-registered investment advisors. First, the subcommittee recommends that the SEC prohibit the use of specific types of restrictive clauses within pre-dispute arbitration clauses and require similar investor protections that are available through FINRA dispute resolution to harmonize the scope and content of pre-dispute arbitration clauses used by registered investment advisors and brokerage firms. Second, the subcommittee recommends that the SEC require notice and disclosure of pre-dispute arbitration clauses and arbitration awards in a manner consistent with disclosures made by brokerage firms under FINRA rules, which is also intended to increase transparency with respect to the use of such clauses and arbitration as a dispute resolution mechanism by registered investment advisors. Third, the subcommittee recommends that the SEC continue to gather and assess data regarding the use of pre-dispute clauses by investment advisors, as well as the outcomes of client-involved arbitrations. And last, the subcommittee recommends that the SEC develop investor education materials that explain arbitration and provide investors with suggested questions to ask either their investment advisor or their broker. With respect to the first recommendation, when pre-dispute arbitration clauses are used by brokers, FINRA regulates the terms of those agreements. For example, FINRA Rule 2268 prohibits the inclusion of certain terms in pre-dispute arbitration clauses, including those that limit or contradict the rules of any SRO, limit the ability of a party to file any claim in arbitration, or to file any claim in court which is permitted to be filed in court under the rules of the forum, or limit the ability of arbitrators to make any particular award. FINRA also prohibits the use of class action waivers. FINRA Rule 12.213 requires that the venue for any arbitration involving a customer be set in the hearing location closest to the customer's residence at the time of the events giving rise to the dispute. And additionally, FINRA Rule 12.800 allows investors to opt for a simplified dispute resolution process for claims of $50,000 or less. As discussed by the panelists, these provisions help to make the arbitration process a fairer and transparent process. The committee recommends that the SEC adopt rules similar to these FINRA rules. This would harmonize the regulation of the use of pre-dispute arbitration clauses, and would help ensure investors working with an SEC-registered investment advisor receive the same types of protections with respect to dispute resolution as investors who are working with a FINRA-registered brokerage firm. Moreover, adoption of these requirements would be consistent with an investment advisor's fiduciary duty to act in the best interest of its client and not place its own interests ahead of the client's interests. With respect to the second recommendation, the focus is on the disclosure and increased transparency when an investment advisor utilizes a pre-dispute arbitration clause. When a brokerage firm utilizes such a clause, FINRA Rule 2268 requires consistent prominent notice of the clause within any customer agreement. The committee recommends that the SEC require similar notice of arbitration agreements or clauses when used by investment advisors. Additionally, the committee recommends the SEC require investment advisors include a copy of any pre-dispute arbitration clauses as part of its disclosure obligations under Form ADV. Further, investment advisors should be required to disclose pending and resolved arbitration claims. This will help level the playing field and ensure investors have access to similar information about disputes and dispute resolution with investment advisors as they presently have about FINRA-registered brokers. Lastly, as discussed above, FINRA maintains a searchable database of FINRA arbitration awards. The committee recommends that the SEC require investment advisors submit any arbitration awards to it to be included in a similar database of investment advisor arbitration awards. Investors should have the appropriate information from which they can make an informed decision about whether they want to work with a particular investment advisor. This recommendation, consistent with the first recommendation, is intended to harmonize investor protections related to disputes and dispute resolutions among both registered investment advisors and brokerage firms. With respect to the third recommendation, the committee acknowledges the difficulties in determining the frequency of investment advisor arbitrations or the frequency of unpaid awards due to the lack of publicly available information, as was highlighted by the SEC study. The committee recommends that the SEC, through its examination program, gather data about the use of arbitration clauses, the terms of those clauses, and the details of any arbitrations or litigations involving investment advisors when firms are examined by the SEC. Periodically, the SEC should make a report of its findings on a collective basis and make that report publicly available. This work will position the SEC to comprehensively evaluate any issue with, as well as the merits of, pre-dispute arbitration provisions. With respect to the last recommendation, the committee recognized the potential role of investor education. The committee recommends that the SEC develop investor education materials that explain to investors what to expect from the arbitration process and how it differs from court. This is something FINRA requires that brokerage firms include within their pre-dispute arbitration clauses. Investors would also benefit from suggested questions they may ask to prompt a conversation with their investment advisor or broker about any pre-dispute arbitration clause. For example, does the account agreement contain a pre-dispute arbitration clause? What are the terms of the clause? Where would the arbitration be held? Who would decide the arbitration? And how would the arbitrators be selected? What are the expected costs of bringing an arbitration claim? And what are the benefits of proceeding with arbitration? Additionally, the SEC should encourage investors to ask about any pending or resolved customer or client complaints. The committee believes these recommendations will address some of the issues that were surfaced during the panel and in the study conducted by the SEC Ombuds Office and Investor Advocates Office. And with that, I will open it up to the committee for questions, comments, concerns. Jennifer.
Thank you. I have some comments. I appreciate the work that went into this recommendation, and I especially appreciated the panel that we held back in December. I thought it was a very illuminating panel and highlighted a lot of very important issues. Unfortunately, I am unable to support this recommendation in full. I am able to support recommendations 3 and 4, which recommend that the SEC continue to gather and assess data about the use of arbitration clauses and the outcomes of client-involved arbitration, and that the SEC develop investor education materials about arbitration. But I am unable to support recommendations 1 and 2. At the outset, I'm pleased that the recommendation acknowledges that arbitration can provide benefits to both firms and customers, as the panel who spoke before the committee back in December highlighted. And although the committee's recommendation does not take a position on whether mandatory pre-dispute arbitration clauses should be permitted, this recommendation is in line with a world in which pre-dispute arbitration clauses are not prohibited. On the substance of the recommendation itself, I am sympathetic to the desire for customers to face reduced complexity in their relationships with broker-dealers and investment advisors. And it is understandable that clients may be confused as to why customer disputes are handled differently depending on whether the financial services provider is a broker-dealer or an investment advisor. It also may very well be the case that the broker-dealer arbitration system in particular may provide benefits to both customers and firms. However, the approach taken by this recommendation, mandating that investment advisors harmonize their use of arbitration agreements to the requirements applicable to broker-dealers by operation of FINRA rules, infringes upon freedom of contract. Investment advisors and their clients should be free to reach terms that govern the settlement of disputes that meet their own needs. While FINRA rules govern arbitration between broker-dealers and their customers, those rules have grown from the industry's agreement to bind its own contractual choices through its own self-regulatory organization. While SRO regulation is far from a perfect model of contractual freedom, it is much closer to such freedom than requiring investment advisors, who are themselves not members of FINRA, to essentially abide by FINRA's rules regarding arbitration. Moreover, I will note that the arbitration process is just one of the many ways that a client's experience differs between using a broker-dealer and an investment advisor. And while consistency of experience for customers between the two financial services providers may be a desirable outcome, it may very well be that differences in arbitration practices may be the result of differences between BDs and IAs. The recommendation references an advisor's fiduciary duties, which, again, are not the same duties that brokers owe to their clients, and which may require different outcomes than the ones that our broker-dealers have agreed to. I am also concerned that the requirements to disclose pre-dispute arbitration agreements in the Form ADV may impact the ability of advisors to reach agreements with clients that take into account the individual circumstances of the client relationship. This type of disclosure requirement necessarily assumes that a pre-dispute arbitration agreement will be a generally applicable form agreement. To the extent that a firm uses different form agreements with different clients, this disclosure requirement may not lead to much clarity for clients relying on Form ADV disclosure. And moreover, this pre-use general disclosure requirement will likely disincentivize IAs from reaching negotiated agreements with clients out of concern that the Form ADV disclosure will become deficient. This again burdens freedom of contract. I am, however, supportive of recommendations 3 and 4. Recommendation 3 asks the SEC to continue to gather and assess the use of pre-dispute arbitration clauses by IAs. This recommendation can help to inform whether any regulation around the use of such agreements is appropriate, particularly in assessing whether IA practices are consistent with IA fiduciary duties. And Recommendation 4 asks the SEC to develop investor education materials about arbitration. High-quality educational materials can serve to empower investors to make their own decisions about pre-dispute arbitration clauses, as well as to help them make their own decisions in choosing an IA or other financial services professional. Thank you.
I would like to just comment in terms of concerns about the freedom to contract. In this case, Congress has explicitly contemplated limiting freedom of contract with respect to this issue when it adopted Section 929 of Dodd-Frank, and allowed the SEC to adopt rules or regulations that could prohibit outright or impose conditions or limitations on the use of arbitration clauses to the extent they were in the public interest or for the protection of investors. And additionally, investment advisors are otherwise limited in what they may include in their contracts. For example, may not contract for a waiver of their fiduciary duty. And to some extent, what the recommendation is intending to do here is spell out in what ways arbitration terms may in fact violate that duty, or otherwise be considered in violation of the anti-waiver clauses. Any other comments?
Yeah, I would, thank you. I support the recommendation. I think that the types of restrictions and prohibitions that have been incorporated into the FINRA dispute resolution model have worked very well. We heard that from the trade association that regulates the broker-dealers. I don't think the differences in terms of services that brokers provide and advisors provide are so different that the types of recommendations and restrictions we're making here really should dictate a different outcome or a different approach. The FINRA process has worked very well, there's no accident that 61% of advisors include these provisions in their advisory agreements. And to sort of say there's freedom of contract in this sort of scenario, I think most investors, one, it's in fine print. If they do read it, they're not going to understand it. And in many cases, they don't have the leverage to negotiate these provisions. And in most cases, these are going to be standardized provisions that the legal department and the firms have signed off on and approved, and there's no negotiation. And so I see this as a package of recommendations that impose essentially fairness provisions in these agreements. And, advisors like to tout the fact that they're fiduciaries, that they are there and we're going to act in your best interest, and we're not going to put our interests ahead of your interests as a client. And to me, these provisions are consistent with that. And then another point on the freedom of contract is the Investment Advisors Act already has made judgments about where freedom of contract should be restricted. You can't have performance fees in an advisory contract. You can't assign an advisory contract to another advisor. There's provisions that you can't disclaim liability in an advisory contract. So, there's a balancing here. There's a lot of places where there's freedom of contract, but Congress has made judgments about where that freedom should be restricted. Dodd-Frank has done that more recently. And so, I view this as a very pro-investor protection measure for us to recommend to the Commission.
Christine, I wonder if you saw that my hand was up.
I did not. Go ahead.
Hi, thank you. On behalf of the Office of the Investor Advocate and the Office of the Ombuds, which is part of our group, we just wanted to take an opportunity to thank the IAC for inviting us to present our research in December and for taking such a thoughtful approach in thinking about the issues that our research illuminated, and wanted to also just express praise for the independent conclusions that the IAC has arrived at in this very pro-investor recommendation. So we just know that it's a privilege to both sit on the IAC and also be invited to present to it, which is in essence what you asked us to do in December, and wanted to acknowledge that on the record and thank everyone for that opportunity.
Christina, thank you very much for those kind words. I know Christine appreciates them. I know we as a committee as a whole appreciate them. And the presentation by Stacy Puente was very, very helpful in framing these recommendations. So thank you.
Okay. Are there any other further comments by the committee members? Okay. So I just want to take a moment to thank the work of the subcommittee on this recommendation and on the panel discussion in December, and in particular, Paul Roy for his input. Thank you.
Procedurally, again, thank you, Christine, for the excellent summary, for the questions, and for the remarks, everybody. Do we have a motion to approve the recommendation?
Motion to approve the recommendation made.
A second?
Second.
All in favor?
Aye.
For the record, two of our members reported to me that they had to leave early, but indicated their support for the recommendation, Gina Gale Fletcher and Colleen Honigsberg. So with that,
If I may,
yep.
mark me as abstaining.
And we'll mark an abstention from Christina. Okay. Any opposed?
In part.
In part, okay.
Recommendations 1 and 2 opposed.
Okay, duly noted. For the record, that was Jennifer Schulp. Thank you. We'll now turn to our subcommittee reports. Brief reports from our subcommittees. We'll start, Jennifer, with you, Investor as Owner.
Thank you, Brian. Investor as Owner has been busy putting together the panel discussion that we heard today on pass-through voting and engaging beneficial owners. The committee has also met several times between the time that we had our last public meeting and today, and continues to work on recommendations from prior panel discussions of the committee.
Thank you, Jennifer. James, on behalf of Purchaser.
Thank you, Brian. Purchaser has been working hard on the panel discussion on non-GAAP today, and we've continued work on terms of what additional panel discussions we could have between now and in September or December. Thank you much.
Thank you, James. Andrew, on behalf of Market Structure.
Thank you, Brian. So the Market Structure Subcommittee, following our December 2024 panel on the mainstreaming of alternative assets for our retail investors, continues to discuss the scope of the potential recommendations. So again, this recommendation will be based on retail investors who would be able to invest in private market assets through registered funds. And so these would be ETFs, interval funds, or business development companies. And so the subcommittee continues to discuss the ways that the 40 Act intersects with retail-facing funds, and also talking through some of the potential conflicts of interest that we want to address in the recommendation, as well as the intersection between retail investors and institutional investors of these assets going forward, whether that comes to issues around valuation, and ultimately we also have want to address the issues around liquidity, especially when we recognize that the liquidity profile of retail investors may in fact be different than institutional investors. So we will continue to discuss these and prepare a recommendation shortly.
Thank you, Andrew. Christine for the Disclosure Committee.
The Disclosure Subcommittee has spent time working on today's recommendation on arbitration clauses, continues to work on a recommendation with respect to the artificial intelligence panel from March, and continues to discuss consideration of additional panel presentations for September or December.
Thank you, Christine. That concludes our subcommittee and working group reports and brings our meeting to a close. Again, I want to thank each of our leaders here today, Jennifer, James, Christine, and their teams for the work that were done on the recommendation and on the two panels. As always, I'd like to thank our investor advocate, Christina Martin-Fervita, along with Mark, Adam, Andrew, and the full supporting team of the SEC staff that keeps this effort running smoothly. And I look forward to seeing you all again at our next meeting in September. Thank you.